to be. This is Professor Mark. He will guide you through today's market and express and explain to you how you need to prepare for it. Mark, what do you see today?
Well, I see my two kids graduating high school, so I'm pretty psyched about that.
Congratulations. That's awesome.
Yeah, thank you. So, going out to dinner tonight. And in terms of the market, I think that it's probably going to be pretty slow until we get some clarity on what the Fed is going to do and what these interest rate or not interest rate, sorry, these inflation measures that are coming in for the next 2 days. So we might get some movement this afternoon. If I want to put up right here our SPY, this is where we usually start, and see how this level back here was resistance at 430, and now we may be getting through it. I mean, we're at 434 in the pre-market, so that's a little kind of too close to really tell yet.
Yeah.
Yeah, it's a little too close. And one of the things people should realize is that this S&P 500 is made up of 500 stocks, right? But it's 13 or 11 different sectors. Sorry, 11 sectors. And if we look through the sectors, we can get insight into what's going on because different things are like in charge in different places or at different times. So the tech sector is very strong. That's where the strength came from yesterday. So we'll have to see if this is like a fear of missing out type buying, which usually comes at the end of an up move, or not. And we'll probably know over the next few days. It's pretty rare that you get economic data that's so important, but just given where we are with interest rates and inflation and so forth and so on, that's kind of where the market is now. You know, the market's kind of always the same, but it's kind of always different. It repeats itself. One thing that's important to watch here is our financial sector. So what I'm looking at here is an ETF, an exchange traded fund, and it is run by State Street Global Advisors, and this spider is S&P Depository Receipt. So you probably people talk about the spiders or SPY. SPY is the S&P 500 one, but fortunately we have these sector ETFs that allows us to be able to track the sector, the different sectors. Now here's our financial sector. And notice how the financial stocks have kind of just been going sideways, and there is resistance overhead. Now, what is resistance, right? When a market's moving higher, there's not enough sell orders or supply to fill all the demands or buy orders. When we get to a resistance level, all of a sudden that dynamic turns. There's a large group of sellers, and they're all kind of want to sell at or around the same price. And what happens sometimes is that some of the investors who want to sell start to sense that there are other sellers in the market. That's why the price isn't going up anymore. And they tell themselves, must be new sellers coming into the market. That's why the price isn't going up anymore. So they start to say to themselves, I got to be the lowest. I got to be willing to sell at the lowest price in town, or else the buyers are going to go to whoever else is willing to sell at a lower price. So they start to undercut each other. And this is why when you get to resistance levels, sometimes you get these tradable sell-offs, right? Like here. And it has nothing to do with fundamental news or, the debt ceiling or whatever Jerome Powell's saying, this, that, or the other thing. It's a psychological thing. And when the market's moving lower, it's a psychological thing in that you get anxious sellers trying to, oh, hey, Sean, how are you? You get anxious sellers trying to undercut each other, right? So it has nothing to do with fundamental news. One of the problems newer people have, and actually even some people that are more experienced, is, when they watch the financial media, the media tries to attribute every single little move to some kind of ulterior fundamental reason. And this is not the case, right? 90% of the time, the market is moved by psychology. Now, when we're going lower, it's the exact opposite. There's not enough demand to absorb all the supply or buy orders to absorb all the sell orders. So we go lower. When we get to what we call a support level, all of a sudden there is enough demand. And now we have the opposite. People who want to buy, right? Support is a large group of investors who want to buy at or close to the same price. When we get to support, all of a sudden the tide turns and there is enough demand. Now, some of the investors start to get anxious and worried that they're going to miss out because the sellers are going to go to who's ever willing to um, pay the highest price. And these buyers start to get anxious and they start to say, I better be willing to pay a higher price or else the sellers are going to go to someone else. So this starts this snowball effect to the top or going up here. So we come off of support because of psychology. We come off of resistance because of psychology. Oh, hello from Malaysia. Hey, I am PG Trader. That's probably got the farthest away award this morning. So anyway, so much of this market is psychology, and people don't seem to think that. People think that the great traders have these secret formulas or secret systems that they found on some kind of like vision quest or whatever, and it's just not the case, right? The best traders understand psychology.
So, Mark, in this move here on XLK, where you've got 4 days where it's built a base kind of 33.14, it doesn't do that often. If you look back over the chart, so
You mean XLF? You mean?
Yeah, XLF. I'm sorry. So will that give us kind of it would give it more of a violent move or a more volatile move when it comes off of this, since it's based up at that level for so long?
It's tough to say. It's tough to say. You know, I don't really know, to be honest with you, but probably because notice how it's been in such a narrow range. Okay.
Right.
So you got kind of the same dynamics. We're just not at a support. Well, I mean, you could say we're at short-term support and resistance.
Yeah.
So it's the same dynamics. You got the sellers watching and the buyers watching, and right now it's kind of even. But eventually it might break one way or the other, and then that's going to cause that cascading effect. Like if it starts to break to the top, the investors who want to buy are going to say, "Oh man, this sucks. I missed out. I shouldn't have been so patient." And they're going to chase it up. So that could make it move up quickly. And of course, the opposite is true. If it starts to break down, the sellers who want to, or the investors who want to sell, are going to start to say, "Man, I shouldn't have been so patient. Now I'm going to have to chase this thing lower," and they're going to sell it. That could start the cascading effect. So yeah, well, there's markets are always moving, right? They're always going up, down, or sideways. So there's always ways to profit. You just got to be aware of how to do so. Like if say the market does reverse, say they come out and Powell says, I'm going to raise rates, and the two inflation measures that we get come in higher than expected, then we could get a pretty decent sell-off here, right? So it's almost like the market is like kind of poised. It's like ready to spring one way or the other. But I really want to hit upon this idea of psychology today. And let me see here. Because I don't think it's letting you see my hold on 1 second. I'm trying to show a PowerPoint presentation, and I think that's kind of what's messing it up.
Add source, Mark.
Where is add source?
Next to the person with invite guests. So while we're waiting on Mark to get that worked out, folks, there's something you really should think about today. I've been noticing and watching and listening a lot, and there's a lot of talk about it's a very touchy subject. There's a lot of talk about suicide because of men's toxic masculinity and men feeling like they're not having self-worth. You really need to take care of yourself, and you need to think about it. You need to live your life to the best that you possibly can, and just let it go. Just be. Don't have such hard pressures on yourself that you don't, that you have to end up taking your life.
But mental illness it's a chemical thing too. I mean, if your brain chemistry is all out of whack, it doesn't matter how positive you are or how much self-talk you have. It's just like if you're a person who's prone to have high cholesterol, you're going to have high cholesterol.
That's
right?
True.
Regardless of what you think. So I'm not obviously a doctor, but I think if people that are depressed, they have too little serotonin in their brains. And I've known people that were very depressed and they go to the doctor, and because there's this like stigma around it, but they finally go and they take some antidepressants, and 2 or 3 days later, it's like their whole lives have changed. So
Oh yeah.
if someone's really feeling bad, they should go to the doctor. It's like if you got a bad heart, you go to the doctor and get heart medicine. If you got a bad brain, well, you go to the doctor and get brain medicine.
But that's my point. Get help, folks. Don't get yourself trapped where you can't get out of it.
All right. So anyway, I'm not able to bring up my presentation yet, but I still can talk about it. So why do most why do most newer traders lose money? And I tell people, Berlin, that I think there's 3 stages of trading. And the first stage is that people come into the market and they think that, they have some money or whatever, and they want to be told what to do. So they go into these chat rooms and they listen to these so-called gurus, and they end up losing money, right? That's because you're guessing. One of the main reasons why people lose money is because they guess. Now, the second stage is people come in and they say, all right, I'm going to develop this like trading system, and it's always going to work and it's going to be perfect. And they develop it, and maybe it's a good system or whatever, but it ends up, when they try to deploy it, it ends up not working. Now, why is it that it doesn't work? And the answer is this: when real money is on the line, people's emotions get involved, and that makes them make dumb decisions, which is, along the lines of the mental, the mental psychology thing that we're kind of talking about.
Yeah.
So here's a quick, simple example I get to people is that if you have some paper trading system, meaning you just develop a strategy on paper, and if you have some paper strategy and on paper it could work, but when you go to deploy it in the real market, it doesn't work. And I've seen this happen like a million times. And why is this? And the answer is because when you have real money on the line, your emotions get involved. Now, say you had your trading system, your paper trading system, and I like to say Wall Street is full of good paper trading systems, because it is, but Wall Street is not full of good traders. So there's a reason for that. Say your paper trading system tells you, all right, let's buy 1,000 shares at $10. So $10,000 is real money for anyone. Now, say your system says, all right, well, let's sell this if we get to, we'll sell it if we get to 15, and we'll take a stop out if it gets to 9. All right. So say the stock starts to go to 11 or 12. You're like, oh man, this is easy. 13, 14, 15. And you say to yourself, oh, this is great, man. I just took a 50% gain. Trading is easy. I could be a new hedge fund manager, blah, blah, blah. And say it goes the other way, all right? It goes to 9. You say, all right, well, I'm taking my $1,000 loss and I'm moving on to something else. So that's easy. Now, let's say you have real money in there and it goes to 1,000. It goes to 11. So you're up $1,000, and it goes to 12 and 13. Then you start thinking, I got $3,000 here. I know my target is 15, but you know what? I'm just going to take it because I'm worried. I'm afraid. I have fear. I'm afraid that I'm going to miss my target here, or I'm going to lose my money. So they sell, and then they leave a couple dollars on the table, or it goes the other way to 9. Remember, when you don't have real money on the line, it's easy to be like, all right, well, whatever, I'm going to blow this out. But in the real world, if you have real money and it goes to 9, you start thinking, gee, I don't want to lose $1,000, and I don't want to admit to myself that I'm wrong. So the good traders are the ones who have this ability to have this strong mental discipline. So that's why most people lose. I've seen anywhere from 70 to 90% of new retail traders fail. I would suspect it's closer to the 90 side, but it's because they guess, they ask for people to tell them what to do, they over trade, they feel as though they always need to be in the markets. I think that's a big one. People need to understand that they don't always need to be in the market. If you're not like feeling mentally up to it, because trading could be pretty intense, right? And if you're not feeling up to it, it's okay to sit on the sidelines. It's okay to take a day off, stay out of the market, take your dog for a walk. Just do something. You don't need to always be in there. And as a matter of fact, one of my favorite Wall Street sayings is, there's a guy who was a great trader back in the 1920s, who actually, talking about suicide, he actually committed suicide. Jesse Livermore, which just goes to show you that even you could be extremely wealthy and still extremely unhappy. But what he said was the way he made his money was not being in the market; it was being out of the market. And what he means by that is he made his money because he had the discipline to sit on the sidelines and wait for something compelling to come along, a low risk trade to come along. And it's like, think about it. The other thing too is it's important to understand that the greatest traders, the Jesse Livermores, the Steve Cohens, the Paul Tudor Joneses, they lose money on trades. People tend to think like these guys are these like super geniuses that have these incredible systems that are always working. And that's just not the case, man. It's just not the case. They have losses too. The difference is that the good traders don't take big losses. The bad traders do. A good trader, when they have a little bit of a loss, they get out of it and they move on to something else. See, people have evolved something that's called fear. And at one point in history, it was probably a useful emotion. If you're walking down the woods and a saber-tooth tiger comes after you, it's good to be afraid, right?
And fast.
Yeah. But here, now, when you're trading money and you get afraid, fear makes you do the two worst things a trader can do. And that's get out of their winners too soon and hold on to their losers for too long. And, here at Stock Market Jobber, we're big history buffs. And I like to read old books on Wall Street. And if you read a book from, say, the 1800s, like I have this book, I believe it's from 1880, and it's written by the guy who was the president of the New York Cotton Exchange. And he has his trading advice. And he just says the same exact things that I just said. Don't get it, let your winners run, get out of your losers quick. And why is he saying the same things? Well, the names have changed, the people have changed, the companies have changed, but what hasn't changed is human nature. And
So you're saying basically that once we master our psychology in this, it's pretty much a done deal. Because if it's the same as it's always been, as long as we control ourselves and our own emotions when we trade, we should be able to succeed in this, correct?
Yeah, I think so. It's not going to be perfect, but yeah, it's
And developing our own trading strategies. You can't live off somebody else saying, "Hey, buy here, sell here," because you're not really learning anything and you don't know anything. Then you're just following somebody's directions. And I've never followed directions well.
well, the market is never wrong, man. People
That's
are
true.
wrong all the time. So anytime you look at a chart, you're looking at this psychology. Like I just spoke about how something comes off of support or comes off of resistance as a result of psychology. Well, let's just look at XLF here, and we could see this on pretty much any chart. This whole idea, or I don't even know if it's an idea, but this whole, I guess, reality that we get some price levels that are more important than others. Now we're going higher. We talked about that's because of lack of supply, and then we get up to resistance, and we can go lower. Now, why would we have resistance here at the exact same level as over here? Well, this has to do with psychology. It has to do with buyer's remorse. There are people who bought here who regret doing so when the price goes lower, and they tell themselves, I want to get out, but I'm only going to get out if I can do so at break even. So when the stock starts, or in this case, the ETF starts to get back up to the price that they bought at, they start to think, oh, gee, here's my chance to bail out at break even. So I'm going to try to sell my shares at the same price that I bought them at. So you have these people who bought here who are remorseful because the price went lower, and they try to sell, and they place their sell orders around the same levels they bought at. And if there's enough of these sell orders, the level that was resistance can remain resistance. So we see resistance at former peaks because of a psychological phenomena, right? Buyer's remorse. Now, here's another place buyer's remorse manifests itself into the market. Notice how the level that was support somehow mysteriously converted into resistance. Well, it's buyer's remorse. There are people who bought here who regret doing so when the price, who are happy at first, but when the price goes lower, they regret buying, and they tell themselves, gee, I'm going to get out at break even if I can. So when the price gets back up to around where they bought it, they place their sell orders. So if you have enough remorseful buyers placing sell orders, support can turn into resistance. So 98% of what moves markets is psychology. It's not, in the institutional trading world, at least the one that I was in. So you can see here, support here becomes resistance here. At least the one I was in. Let's see. Hold on one second. Just have it hold in here. Yeah, so resistance here becomes support here. So in the institutional trading world, people aren't talking about these like strange science fiction type things like Gann theory and Elliott wave. What they're doing is paying attention to this to what real technical analysis should be. It's um, it's where are the important price levels, what's the momentum, and what's the psychology. Now, momentum is a measurement of how far something has moved from time period A to time period B. And when we get above what would be its typical or usual trading range or historical trading range, we call that overbought. Now, this is because buyers get, for whatever reason, get extremely aggressive, and they all of a sudden they decide, like, I just got to go out there and buy it at any case. So that leads us to conditions that we call overbought. If we get above that historical range, we're call it overbought. This is a psychological thing. It's the buyers started to get freaked out that they were going to miss out, and they just go and they pay any price, and that tends to happen at the end of an uptrend. And you can see how it happened right here. Down on the bottom here, this is what we call our relative strength index. Okay, this is a chart or an oscillator that measures momentum. Again, momentum is how far something has moved from time period A to time period B. If we get to an extreme, we call this overbought. And why is this important? Well, these conditions are going to draw sellers into the market because they're going to be expecting a reversion to the mean or a move lower. So overbought, we tend to sell off. Okay. That's especially the case when you have overbought conditions and you get to a resistance level. Overbought draws buyers into the market, and resistance is a large group of investors who want to sell. So you got this kind of like this double whammy going on here. You're overbought and you're at resistance. There's a good chance the market's going to go lower. Not a guarantee, but a good chance. And sure enough, that's what's happened here. And then we can see here the opposite is oversold when something gets below what would be its typical or usual trading range. And that's indicated by this, when this blue line gets below the red line or above the red line, here it's overbought, here it's oversold. So this is a very simple indicator. It's not perfect, right? But it kind of just helps out, giving you a good visual reference on things. See over here, we got really oversold, and that was a good time to buy. Actually, I'm going to bring up Tesla because there's some really
This thing's been ripping.
there's some really educational things going on over here at Tesla. I mean, I could spend, hours just talking about the technicals on this. All right, now let's just look here. So this is Tesla. Yeah, see, we're really overbought here now. So we'll take a look at that. And we're up a little bit even in the pre-market. Now look at here. Tesla gets to support, and it's very overbought. Oversold. As a matter of fact, if we go all the way back to the beginning of Tesla, which I think was in 2011 or 2012, this was the most oversold it had ever been in its history. When things get to historic levels, you have to pay attention as a trader. Sure enough, we got to support and we rallied. Now, why was this level here, 110? Why was it support? Well, remember, some price levels are more important than others. And for whatever reason, 110 is an important level for Tesla. So here we are back in 2020, right? July of 2020. So almost 3 years ago. And we move higher. We get to resistance. We sell off a little bit. Well, actually, that's more than a little bit. But then we break through and we come back and we find support at the same level that was resistance. Now, why does this happen? Well, this happens because of seller's remorse. Again, it's a psychological thing. There's investors who sold here who regret doing so. When the price goes higher, they tell themselves, I'm going to buy my shares back, but I'm only going to do it if I can get them for the same price I sold them at. So you have remorseful sellers placing buy orders. And if there's enough of them, the level that was resistance can convert into support. Now, This is what we call market memory. A level that's important can retain its importance for a long time, years. I mean, I've even seen cases where it's decades. It's kind of hard to believe, but it is true. And I can show you some examples before we're done here. But this is the end of 2021. This is where the bull market that started 10 years before this came to an end. From a from a market point of view, COVID was really kind of just a blip on the map because the market crashed, but then it was making new highs just a month later, right? So, I mean, COVID was a terrible thing, but from a market point of view, it wasn't that much. So basically, this is the very, very end of this decade long bull market. And notice how this thing is just gapping up and ripping higher. And look at here where it's got overbought. This is the most overbought that Tesla had ever been in its history based on this indicator. So things get to historic levels, you got to pay attention. Now, sure enough, what happened? This was right at the very, very, very top. Okay. So this is perfect example of a fear of missing out buying. There's people that are probably watching it here. It's going higher. You know, they're talking to their friends at the office, and it's like, hey, well, or talking to their friends from their home offices. But you know, it's like, all right, well, I'm gonna watch it. You know, it's at 240. I'm gonna wait to see if it comes down to 220, or it's at 250. I'm gonna wait. And it just keeps going up and up and up and up. Finally, these people get really frustrated and they say, you know what, the hell with this. I'm just going to go out and buy it regardless of the price. And these are the people that tend to be the last people to the party. Remember, for every seller, there's a buyer. Every trade has a buyer and a seller. So, arguably, you know, I'm not going to, I don't mean to insult anyone, but the smart money is buying down here and selling up at the top. The not so smart money has been on the sidelines for so long that they completely missed out, and then they regret doing so, and then they jump on in and they go to buy. So we can see this psychology, fear of missing out gets things overbought. Over here, in more recent times, this was December, right? People start to panic. Oh, it's going lower. It's going lower. I want to sell. I got to sell. And they hold on and they hold on and they hold on. And finally they say, you know what? I'm sick of watching this thing go lower. So I'm going to just sell it regardless of the price.
So,
Okay.
Mark, to combat that FOMO, so are they better off? Did they just need to let the chart set up and show them where it's going to go before they go into it? Correct.
Yeah. What you need to do is, and I know this sounds a little counterintuitive, but you're if you want to be a trader, you got to think this way, right? My job is not to make money. My job is to develop a strategy or a system that makes money, and then I need to stick with it. So that's what it is. If you and there's no perfect strategy. Everyone has a different personality. So what works for one person is not going to work for another person, which is I think it's these whole things like, oh, you know, like you know, pay a fee and like watch me trade or learn my system. It's like
Yeah.
it's like why watch someone else trade? Because you're not going to trade that exact same way, you know. So you develop a strategy, and different people like different things. Some people like moving average crossover. Some people like trading when things come off of resistance or support, which is kind of my, I guess, forte. Um, but you know, everyone's different, and it might take some time, a couple months. You know, start something out, do it on paper, develop a good strategy, and then you know, once you're comfortable with it, then you got to start putting some money into it so you can get those emotions to see how you can react to them. And you know, don't start with so much that if you lose it all, you're going to be out on the street. Just start with just enough to make it so you feel the emotions, like just enough to care. But you don't want to make it when so if you like really lose, you're really losing a lot. You got to kind of just you know go slow, right? You start off like being a beginner, and then as you get more confidence and so forth, then you put more money in.
Got a question from Tommy on the CPI, Mark.
Will we be? Oh yeah, we look at all we pretty much follow all the important economic data. You know, sometimes it's important and sometimes it's not. It's not. We just happen to be now at a period in our history or you know current time where you know everyone's looking at inflation, right? And I mean, inflation. I first started trading in like the mid '90s. So I had never experienced inflation. I mean, I did when I was a kid in the late 70s, and I vaguely remember like going to the store and buying candy, and then going to the same store a month later to buy the same candy, and it was like the price was higher.
You're right.
But so now we're in this point where we got to worry about these inflationary things, and the sad thing is this is all self-induced. Okay, the inflation in the 70s came because of things that were going on with OPEC, so we really didn't have any kind of control over that. But people talk about, yes, we put too much stimulus in, and that's true. Also, is the energy policy, the way oil skyrocketed, and there's this whole like myth or lie. I'm going to just call it a lie because that's what it is. That the war in Ukraine caused inflation, and it's like, no, it didn't. Inflation caused the war. The Russian economy is based on oil, and when there was the election, when Biden took office, oil was $32 a barrel. When Russia invaded Ukraine, oil was $100 a barrel. So you tell me, did that inflation happen before or happen after? And now it's back down to the 70s.
And that funds Russia, since most of their the majority of their budget comes from petroleum reserves.
Yeah, they run on oil, and it's not a coincidence that once it got to 100, they invaded. The last time it got to 100, which was, I mean, I don't even remember when. Is that
I
when
want to say it's 14, and then they went into Crimea, but that was because they had it set up with the Sochi Olympics. They just slipped right into Crimea there on a little slide tip.
But look at this here, right? So so it's not a coincidence, because the higher oil prices let them fund their army. So so back here, right? This is Crimea 14. We were up to like 107 or 108.
Kind of like it's set up. You'd wonder if you're thinking maybe, every time that happens, they're able to take a country.
Pretty much. Pretty much. They're like a one-hit wonder. Well, they're not really a one-hit wonder, but it is their most important. And I forget the exact number, but I think Russia needs oil to be like around $68 a barrel for them to be able to. Oh, well, look at this. What a coincidence. Look where it's trading right now.
Yeah, well, yep. I believe that's what I've read also, $68 a barrel.
And, one of the things, I mean, I'm not an oil expert, but there are certain price levels that have more importance in oil than would say in like a stock. Like, just for example, Russia needs oil to be $68 a barrel for their economy to function at a surplus. Well, for all we know, this is Russian, commodities traders and commodities companies that are propping it up in here.
You might want to check the CPI, Mark. We shot to 435 on the SPY.
Let's see here. What was the number? Let me just see here.
We're 435 on the SPY. I didn't catch the CPI data.
One of the things we do too is we kind of go over the news every morning to see just for stuff to see if it's tradable. All right, so it hasn't hit the paper yet. All right, let's find another website where they might have it.
This is kind of what we do, guys. We'll come through and we'll show you these free resources so that you can bookmark these and keep them. That way you're able to find pretty fast information and pretty solid information straight from the source.
All right, so it came in at 4%. And the price index, according to check back for updates. So if the market's moving up, that means it's lower than expected.
Right.
But let's see.
Still higher than it should be. And another thing too, most of these are self-imposed problems that we put on ourselves because we do these yo-yos and these yo-yo flips in policy. You have an economic 3 years ago, what is this, 2023? 3 years ago, we had the hottest economy we've ever had in the history of the country. And now, I mean, you can't even hardly find toilet paper to blow your nose. And it's just sad. I mean, it's just really ridiculous. We have to do these giant swings, and every single person that's not part of these bourgeoisie or the elite, we suffer.
Well, we have a bunch of incompetent people, running the country. It's really just that simple. I don't know where they found some of these characters, but look at look, perfect examples. Look at Jerome Powell. The guy's been wrong for the last 3 years, and yet somehow he still has his job. I mean,
Oh yeah.
I know it's a government job, but the reason why they were wrong, him and Janet Yellen and the other rest of the crew there, is because they follow what we call Keynesian economics, right? John Maynard Keynes was this famous economist back in Britain, like in the 1920s. And just to kind of make it, like, to summarize it or give it the executive summary, the Keynesians only focus on what we call the demand side, which is the consumer. So when they see interest rates going up, they think, oh, gee, this is great. It's a sign that the economy is expanding. And when interest rates get high enough, then it'll slow the economy down. And therefore, inflation will be transitory because rates will come down. But what they don't pay attention to is the money supply, which to me is kind of just extraordinarily, egregiously incompetent. I don't understand how people in important positions can be like that. Um, but but yeah, all they focused on was the money supply, and the money supply increased because of all the stimulus that they put out there. Now, when you put out more money, it causes inflation. If you have more money chasing the same amount of goods, you get inflation. If you have a hypothetically a closed economy with 100 goods and $100, those 100 goods are going to end up costing $100. If the government comes along and it's like, oh, here's another $100, and now there's $200 in the economy, but there's no more goods, all those goods are going to end up to be costing $200. So it's money supply is very important, and I don't know why they don't pay it. Well, I do know why they pay attention to it. It's because they follow this Keynesian stuff, and he didn't pay attention to money supply. The money supply economists came out much later than that. And you might say, Mark, that sounds interesting, but there's no way people in these high power positions can be so incompetent or whatever, so tied into some theory. And I will tell you this, that Alan Greenspan, the guy who's responsible for the NASDAQ bubble and the housing bubble and the commodities bubble, after the housing bubble, the Congress or whoever it was did a big study on what were the causes. And one of the things they said was that Alan Greenspan was too stuck on the teachings of Ayn Rand.
Well, I mean, politics is a popularity contest anyway. I mean, I've served with some absolute people that I don't know couldn't open a plastic bag. I mean, it was that bad. And it's just really bad when you don't have people. You give them positions, right? And they get elected these positions, and everybody has the right to be elected. But they get elected, but then they put in no effort to actually do a good job. And when you serve on these positions, you're using other people's money. It's not your money, it's the taxpayers' money. So therefore, you're not wasteful with it. You should do best with it as you possibly can. And it's shameful. It's a waste to have people not know how to manage anything and put them in these positions and then have them not do the job too. And it's an incompetent thing that you see across the board on all levels of government. And it's not just at the local level.
Well, I think what we need is term limits because,
True.
like, the biggest problem, in my opinion, facing the country is the fact that is our deficit, right? And why is the deficit so high? Well, think about this. When Social Security was invented back in, I think it was the 1930s, the average person in this country did not live long enough to get it.
Right.
Whatever, I don't know what the exact numbers are, but say the
Like
retirement
48.
age.
I think it was 48 or 52 you died.
Yeah, so most people didn't live to get it. Now you have people that are living into the 90s or hundreds, and you got this whole big baby boomer generation that's retiring, and there's just not going to be enough population to support it. So what do we need? We need someone to come along and say, hey, we have to raise the retirement age. It's just that simple. People don't want to hear that. Look what happened in France. They just said they were going to raise the age and there were riots. Now, if you had a politician who wasn't going to get reelected or couldn't get reelected because of term limits, maybe they would actually do the right thing and say, all right, you know what? I know people don't like this, but I don't care. I don't need their votes anymore. I'm going to do the right thing and I'm going to raise raise the retirement age. Nowadays, people need to worry about getting reelected, so they don't do the right thing. They just do whatever soundbite they have or whatever policy they think works. You know, all they do now is give away money. They don't talk about things like, you know, oh gee, the government's out of out of money. We can't pay you. Sorry, you know. So I mean, look, I'm just one guy sitting here in my room in Connecticut, so I don't think I can change anything. And who
Yeah,
knows
but
if
you know
it'll ever
what?
change.
One guy can change anything. All it does is takes for one person to stand up, and you have to make the noise. You know, we had a congressman here where I lived named Congress. Well, he was a doctor. I call him Doctor Ted Yoho because I think being a doctor is a lot more prestigious than being a congressman. But anyway, his name was Congressman Ted Yoho. And he said, I'm only going to go up here and serve for 8 years if I get elected. These, you know, over the next, this is a 2-year term for Congress. He said, I'm only going to serve these 8 years, and I'm not going here to be, you know, to stay here for life. I want to go. I've managed a successful business. I want to take what I've done as a successful vet, large animal vet, and I want to go here to Congress and I want to try to help the country. And he did a great job when he was there. And he's left. The lady that took his place now is she was actually his chief of staff when he started, and she's pretty sharp. Her name's Kat Kamick, but you know, he just really did a good job. And I'm not a conservative as far as that. I'm more of an independent person. Um, but you know, fiscal responsibility is kind of the reason why we're in this position that we're in, is because nobody pays attention to the money that's being spent. And you're right, it's the deficit. The deficit's going to kill our country.
Yeah, there's both sides. I mean, you can't say it's one side or the other.
Yeah,
I
it's
mean,
not. It's both of them. No other. We've got a uniparty in this country. I mean, let's be completely honest with ourselves. They may have an R and they may have a D and they may have an I, but there's a Washington class, and the rest of us do not count except for the money that we send to the IRS, and it's just that simple.
yeah, it's like, what was that famous? I mean, I forget, but the famous reporter said, or it's a famous thing that when Nixon won, someone, I think it was at the New York Times, said, you know, I don't know a single person that voted for Nixon. But,
well,
you know,
well, we
but
watched old
I got
Joey
enough
sit in the
votes to,
basement for months, and he won.
the guy got enough votes to win.
So I
So
mean, it is what it is. You know, and listen,
all politicians like giving out free money. It's just
let's give them what they want, Mark. Let's go through the markets so that everybody understands what they got to do.
all right. Let's see. So let's see how much time I have left here. All right, yeah. So we're 4:30. Looks like we're getting above it here, right? Market continues to move ahead. Not a huge move higher, but after a big day yesterday, it's that's good action for us to kind of keep moving up a little bit. Now, one of the things we do is we go through. Let me just show you here. These Spider ETFs are run by State Street. Um, so if we just type in the symbol, if I could figure out how to type, and then go to SSGA for State Street Global Advisors, this will give you the overview of what is in the S&P 500. Okay, so remember this is an ETF that's designed to track the S&P 500. Here are the 13 different sectors. I mean, why do I keep saying 13? Here are the 11 sectors. So different things are in the driver's seat at different times. We got industrials, we got communication services, financials, consumer discretionary, healthcare, technology. So tech is the biggest, healthcare is the second biggest, financials are the third biggest. And then we have these little ones over here, which they don't really, utilities, materials, and real estate, there's such a low weight that they don't really affect the broader market as much as the other ones, but we do go through them and we look for trading ideas. If we see a sector that looks like it's about to move, as traders, we want to find things that look like they're going to make an imminent move, right? And when I say imminent, I mean it depends on your time horizon. But if you're, say, like a swing trader and you're someone who's trading for taking positions for a few days or maybe a few weeks or a month, you want to find something that looks like it's going to move imminently, next few days, maybe a week. How do things move? What's going to make something move? Well, it's overbought or it's oversold. It got to resistance or it got to support. Those are things that tend to move. Because we got to talk about equilibriums, right? Or is the market in equilibrium? Is it out of equilibrium? If the market's in equilibrium, it's just going to trade sideways. And as traders, it's like, well, big deal. So these are the sectors. Now, consumer staples is a small sector, but sometimes you can get some interest in action out of this because money tends to flow into consumer staples before the broader markets go lower. So sometimes we can get what we call a flight to safety, like a flight to safety type signal. People in the institutional world, a lot of times they have these mandates where you can't have more than say X percent of cash in your account. A manager might think, hey, the market's going to go lower. I'm really bearish. You might say, well, why don't they just sell everything and go to cash? Well, the answer is they probably can't, because they have these mandates that you need to have 95% of your money in cash, for example. And that comes from their clients, because the top of the Wall Street food chain is the pension plans. People think these hedge funds are so mysterious and everything, but it's the pension plans, and they need money managed for them. So a pension plan might say, okay, we're going to put X amount in commodities, X amount in bonds, and we want to have this amount in stocks and this amount in cash. Well, if they hire a manager to manage, if that manager gets too much cash, then it's going to break the strategy. All right. So the money managers just can't go to cash, because then the client might theoretically have too much cash in their investments. So what they do is they figure out, all right, well, the market's going to go lower, but let me go to the stocks that are going to go lower the least amount. And there's this perception, and notice I say perception because it's not a guarantee, but there's this perception that consumer staple stocks are safe. And these are the companies that people need, make products people need, like food and medicine. Energy, too, is only 4.2%, but energy can be pretty impactful on the rest of the market. So that's why it's worth watching this, too. All right, so let's see. We looked at tech, and the second biggest financials. Now we can look at consumer discretionary, which is the next biggest one. Look at this. This is getting pretty. So this is overbought. Okay, see here on the RSI, we're overbought. And look where we're getting to. Let me just get rid of these here. Notice how we're getting close to a level that was resistance before. So this black line here is 166, and we're at 164 in the pre-market. Mm-hmm. So this would be the type of thing we look for. Overstretched. I mean, I know what this is. This is mostly Tesla here. Tesla, that is one of the biggest names in this company or this sector. But I'm just to show you kind of the thought process. Stretched out, and if we get up here, there's a good chance that we go lower, because we know that things that are overbought and get to resistance tend to go lower. Now we're looking at this sector in and of itself. So this is the aggregate. This is like the average of the sector. There are stocks in the sector that are going to look more compelling than this, and there are stocks that are going to look less compelling. Next up, we got our industrials. And once again, we got another sector that's right up against resistance. So notice this resistance at 103.50. Remember, resistance levels can stay intact because of our buyer's remorse. There are people who bought, market goes lower, they regret doing so, they tell themselves they want out, but only if they can get out at break even. So they place their sell orders at the levels that they bought at. And that's kind of right where we're getting now. And this is, again, an example of what we call market memory. Sometimes these levels can retain their importance for a long time, longer than you would think. I think a good example of that is the CVS chart. I like to show people this because I got a chart here that goes back. Okay, so we're going back to... Yeah, this is CVS. Let me bring this up here so you know what it is. All right, so we hit resistance way back here in 2015 in July, right around this 111 level. Fast forward to last year, January and February, where did we hit resistance? Right around 111. We could see here this $83 level retained the resistance level, retained its importance for 2.5 years. This 77 resistance level retained its importance for a year. 52 was important for a year. This is what we call market memory. And it's kind of interesting, and people take it for granted. But if you were to talk to like a typical fundamental money manager and said to them, well, how is it that CVS had the exact same valuation back in July 15 as it did in January of 22? when so many things have changed, different interest rates, oil's different prices, blah, 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 blah. And the answer is, well, it's because it's psychology. It's if you don't look at these charts through the context of psychology, then you are going to have a hard time understanding what it is that you're looking at. So yeah, so that's a good example of that. I guess before I wrap it up, we'll just go through some of these other little sectors here, because again, they might not have a big influence on the market, but you can certainly look at them for trading ideas. Now look at this, right? This is our utility sector. We can see these principles: support, support, resistance stays intact, support becomes resistance. I don't pay attention to too many patterns, but I do think that these, what we call a descending triangle pattern, is worth watching. And you can see that this is the triangle, right? So we got there and there and there. So it's important to understand when you look at a pattern, you got to view it through the context of what does it tell you about supply and demand. Now you got the buyers are just kind of hanging out down here around 70, right? So they're like, all right, well, if it comes to me, I'll buy it. If it doesn't come to me, big deal, I'll miss it. I don't really care. But at the same time, what do you have here? This is called a lower high. Markets go in peaks and valleys. And when the peak forms at a lower price than the prior peak, it tells us something. It tells us that the investors who want to sell are getting more aggressive. They're willing to sell at lower prices. So over this time period here, from December to January, right, this month or 2 months in here, you have buyers who are kind of patient, and you got sellers who are getting more aggressive. When that happens in any market, it sets the stage for the price to move lower. And that's sure enough what happened here. A descending triangle is a bearish pattern. And we could see here support turned into resistance. So those are one of our principles. Now, so this is something we would keep an eye on. We look through this stuff pretty much every day. If we get down to support again, there's another chance it bounces. If we get up to resistance, there's a chance it sells off. Then we look at the stocks that are within the sector for trading ideas. Let's see here. This is our real estate. And, once again, we could see resistance became support. Resistance became support. Now we've reached a resistance level. Trading right around there. Not surprising that that's where we stalled out. I think this basic material sector is also another good example of this concept of market memory. So look at this $81 level here. That's this black line. We can go all the way back to June of 21. So now you're probably saying, well, all right, Mark, I believe you. I believe some price levels are more important than others. So what am I going to do with that? Well, the answer is when you know where these price levels are, it lets you know where to set your prices. For example, say you happen to buy XLB when it was at 76, and you tell yourself, you know what? I think I'm going to sell this if it gets to 82. Well, if you do that, you're really just guessing that, it might get there, it might not. The best traders let the market tell them what to do. And in this case, the market is saying, hey, the 81 level is an important level. There's a good chance if we get there, of course, you might break through and get up to 82, but there's a good chance that it rolls over. So you would say, selling at 82 is not as good as selling at, say, 80, but it's better than selling at 80 is better than missing it. So you would let the market tell you where to put in your order. And that in that case, you're not guessing. If the market's trending lower and you start to think, gee, I think I want to buy this XLB. Where should I buy it? Oh, I'm going to buy it if it gets to, 74, hypothetically. Well, it might not get there. It might get to 75 and then bounce. So you'd probably, from a risk reward point of view, be better off placing your order around just above 75, maybe 75.50. So if you know where these levels are, it makes it much easier to trade because you know where to place your orders. And I got to I'm already 9 minutes late, but I got to get going. So thanks, everybody. And make sure you check back. I think we'll be here tomorrow.
Yeah, we'll be here in the morning. Listen, guys, do something nice for somebody today. Pass along some positivity. We're all part of the same human condition. Let's love one another. Thank you very much. Have a blessed day.
All right, everyone. Thank you.